BlackRock just executed the largest capital exodus in American financial history. $2.1 trillion didn't just move, it vanished from U.S. markets. And before you dismiss this as another clickbait headline, understand this. BlackRock doesn't make $2.1 trillion decisions on a whim. They see something coming that most investors are completely blind to. Here's what Wall Street isn't telling you. This isn't about diversification or standard rebalancing. This is institutional money, the smartest, most connected money on the planet, repositioning before a seismic shift. When the world's largest asset manager, controlling more wealth than the GDP of every country except the US and China, pulls money at this scale, it's not a yellow flag. It's a 5-alarm fire. Your 401k, your savings, your retirement, they're all downstream from decisions like this. And while mainstream media feeds you comfortable narratives about global opportunities, sophisticated investors are reading between the lines and adjusting accordingly. The question isn't whether this affects you, it's whether you'll understand how before it's too late. In the next few minutes, I'm breaking down exactly where this money went, why it matters more than any Fed decision this year, and the 3 specific moves you need to consider right now. If your financial future matters to you, smash that like button and let's decode what BlackRock knows that you don't. So let's get right into this, because what I am about to share with you is going to fundamentally change how you think about where your money should be positioned right now. BlackRock's $2.1 trillion move isn't just a number on a spreadsheet. It represents the largest coordinated shift of institutional capital we've seen in modern financial history. And if you think this doesn't concern you because you're not a billionaire or you don't manage a hedge fund, you're making a critical mistake that could cost you decades of wealth accumulation. Let me start by giving you some context about who BlackRock actually is, because I think a lot of people hear the name and they know it's big, but they don't truly understand the scale we're talking about here. BlackRock manages approximately $10 trillion in assets. Let me say that again so it really sinks in. $10 trillion. That's more than the entire GDP of Japan and Germany combined. That's more money than most people can even conceptualize. To put it in perspective, if BlackRock were a country, it would be the 3rd largest economy on Earth. They have their fingers in literally everything. Your pension fund, your retirement account, the mutual funds your financial advisor recommended, the ETFs you bought because some influencer told you they were safe. BlackRock is behind a massive portion of all of it. Now, when an organization of this magnitude decides to move $2.1 trillion out of U.S. assets, that's not a tactical adjustment. That's not Larry Fink waking up one morning and deciding he wants to try something different. This is the result of hundreds of analysts, economists, geopolitical experts, and financial strategists, all coming to the same conclusion at the same time. They see something on the horizon that makes keeping that money in America less attractive than moving it elsewhere. And here's the thing that should really make you sit up and pay attention. These people have access to information and analysis that you and I will never see. They have direct lines to central banks, treasury departments, and government officials around the world. They know what's coming before it hits the news, before it hits the markets, and definitely before it hits your portfolio. So where did this money go? That's the question everyone should be asking, but almost nobody in the mainstream financial media is actually investigating with any depth. They'll give you surface-level answers about emerging markets and diversification strategies, but that's not the full picture. What we're seeing is a massive reallocation into 3 primary areas, and each one tells us something crucial about what the smart money expects to happen over the next 5 to 10 years. The first major destination for this capital is Asia, and I'm not just talking about China, although that's certainly part of the equation. We're seeing enormous flows into India, Vietnam, Indonesia, and other Southeast Asian economies that are experiencing the kind of explosive growth that America saw in the 1950s and 60s. These countries have young populations, growing middle classes, increasing consumer spending, and governments that are actively courting foreign investment with favorable policies and tax structures. BlackRock isn't stupid. They're looking at demographic trends, and they know that the future of consumer growth is not in aging Western populations where birth rates are below replacement level. It's in countries where the average age is under 30 and millions of people are entering the middle class every single year. But here's what makes this really interesting. It's not just about chasing growth in developing markets. There's a deeper strategic calculation happening here that has to do with the changing nature of global power structures and economic alliances. We're watching the slow motion decline of American economic hegemony, and I know that's an uncomfortable thing to say, especially if you're American, but the data doesn't lie. For the past 75 years since the end of World War II, the US dollar has been the world's reserve currency, which means every country needs dollars to buy oil, to trade internationally, to hold reserves. This has given America an extraordinary privilege. We can print money and export our inflation to the rest of the world because everyone needs our currency. But that system is cracking, and it's cracking faster than most people realize. We're seeing more and more international trade happening in currencies other than the dollar. China and Russia are trading oil in yuan and rubles. Saudi Arabia, which has been the cornerstone of the petrodollar system since the 1970s, is now accepting yuan for oil sales. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working on creating alternative payment systems that bypass the dollar entirely. When BlackRock moves this kind of money out of America and into these regions, they're essentially placing a bet that the next century of economic dominance is not going to be American. They're positioning themselves for a multipolar world, where economic power is distributed across multiple regions rather than concentrated in the West. The second major destination for this capital is Europe, and this one surprises a lot of people because if you've been paying attention to the news, Europe doesn't exactly look like an economic powerhouse right now. They've got demographic problems, energy crises, political instability, and sluggish growth. So why would BlackRock be pouring hundreds of billions into European assets? The answer is actually quite sophisticated, and it has to do with regulatory frameworks and the energy transition. Europe is ahead of America in terms of establishing clear, predictable regulatory environments for certain industries, particularly in green energy, sustainable infrastructure, and technology. When you're managing trillions of dollars, regulatory clarity is worth its weight in gold because it reduces risk and allows for better long-term planning. European governments have committed massive amounts of public funding to green energy infrastructure, and they've created policy environments that make it extremely profitable for private capital to invest alongside government spending. We're talking about solar farms, wind energy, hydrogen production, battery manufacturing, electric vehicle infrastructure, and smart grid technology. BlackRock sees this as a multi-decade investment opportunity where the returns are essentially guaranteed by government policy commitments. Unlike America, where energy policy swings wildly depending on which party controls the White House, European commitment to decarbonization is bipartisan and locked in for the long term. That kind of stability is incredibly attractive when you're trying to deploy capital at scale. But there's also another factor here that most people aren't talking about, and it has to do with the weakening of the US dollar. Now, I mentioned the dollar losing its reserve status, but even before we get to that extreme scenario, we're seeing the dollar weaken relative to other major currencies. And that has huge implications for international investors. When BlackRock holds assets denominated in euros or other currencies and the dollar declines, they make money just from the currency appreciation alone, separate from whatever returns the underlying assets generate. If you believe the dollar is going to continue weakening over the next decade, and there are very good structural reasons to believe that it will, then holding a significant portion of your portfolio in non-dollar assets is just smart portfolio management. It's hedging against dollar decline while still maintaining exposure to developed market economies. The third major destination, and this is the one that I find most fascinating, is alternative assets in private markets. We're seeing massive flows into private equity, private credit, infrastructure projects, real estate in specific markets, commodities, and even digital assets, though BlackRock is obviously very careful about how they talk about that publicly. What all of these assets have in common is that they are not tied to traditional public equity markets, which means they offer diversification benefits when stock markets get volatile. But more importantly, they offer protection against inflation, and inflation is the silent killer that most retail investors are not adequately prepared for. Here's something you need to understand about the current economic environment. The official inflation numbers that the government reports are significantly understating real inflation as experienced by average Americans. The CPI calculation has been modified multiple times over the decades to make inflation appear lower than it actually is. They use hedonic adjustments, substitution effects, and geometric weighting that all serve to push the official number down. But when you look at the actual cost of housing, food, energy, healthcare, education, and insurance, the things people actually spend money on, real inflation is running much higher than the 3 or 4% the government claims. BlackRock knows this, and they know that traditional 60-40 portfolios of stocks and bonds are not going to protect purchasing power in a high inflation environment. Bonds get destroyed by inflation because they pay fixed interest rates that don't keep up with rising prices. Stocks can provide some inflation protection, but only certain types of stocks, and even then it's not guaranteed. What really protects wealth during inflationary periods is hard assets. Real estate that generates rental income that rises with inflation. Infrastructure assets like toll roads and utilities that have pricing power. Commodities like gold, silver, oil, and agricultural products that maintain their value regardless of what happens to paper currencies. Private credit, where you can negotiate inflation adjustments into loan terms. These are the kinds of assets that preserve and grow wealth when currencies are being debased. And that's exactly where BlackRock is positioning this capital. Now let's talk about what this means for you specifically, because that's ultimately why you're watching this video. You want to know how this affects your financial situation and what you should be doing about it. The first thing you need to understand is that institutional money moves first and retail money follows later, usually after the opportunity is already mostly priced in. BlackRock made this move now because they're getting ahead of trends that haven't fully played out yet. By the time your financial advisor at the big brokerage firm starts recommending international diversification and alternative assets, it'll be because the institutions have already positioned themselves and they're comfortable letting retail investors come in and provide additional buying pressure. This is how the game has always worked. The smart money moves first, quietly and efficiently. Then the slightly less smart money notices and follows. Then the financial media starts talking about it. Then the retail advisors get on board. And finally, regular investors pile in right at the top, just in time to hold the bag when the next shift happens. If you want to build real wealth, you need to be paying attention to what the smart money is doing now, not what financial television is telling you to do, based on what happened 6 months ago. So what should you actually do with this information? First, you need to seriously evaluate your current portfolio allocation and ask yourself if it's positioned for the world as it's going to be, or the world as it was 20 years ago. If you've got everything in US large cap stocks and maybe some bonds, you're essentially making a bet that American dominance continues indefinitely and that we are not going to see significant inflation or dollar devaluation. That might work out, but it's a concentrated bet on one country at a time when global economic power is clearly fragmenting and redistributing. You should be thinking about increasing your international exposure, but not just by buying some generic international index fund. You want targeted exposure to the specific regions and sectors where capital is actually flowing. That means looking at emerging market funds focused on Asia, particularly India and Southeast Asia. It means considering European stocks and sectors that benefit from the energy transition. It means thinking about how to get exposure to infrastructure, real estate, and commodities without taking on excessive risk or paying exorbitant fees. One of the easiest ways for retail investors to follow institutional money is through ETFs that track specific themes. There are India-focused ETFs, Vietnam ETFs, clean energy infrastructure ETFs, commodity ETFs, and real estate investment trusts that invest in specific property types in specific markets. You don't need millions of dollars to implement a more sophisticated allocation strategy. What you need is awareness of what's actually happening in the world and the willingness to move beyond the default options that most people never question. The second thing you need to do is get serious about inflation protection. If you believe, as BlackRock apparently does, that we're in for an extended period of higher inflation and currency devaluation, then you need assets that maintain purchasing power. This means reducing your exposure to long-term bonds, which are going to get crushed if inflation stays elevated. It means thinking about your allocation to real assets. Real estate can work if you're in the right markets and you're generating rental income. Commodities provide direct inflation hedging. Even certain types of stocks, particularly in energy, materials, and companies with strong pricing power, can protect you better than broad market indexes. And then there's the question of gold and other precious metals, which is always controversial because there are passionate advocates on both sides. But here's the reality. Central banks around the world, including China, Russia, India, and many others, have been accumulating gold at the fastest pace in decades. They're doing this because they understand that in a world where currencies are being devalued and the dollar's reserve status is uncertain, gold serves as the ultimate form of money that no government can print into existence. You don't have to put your entire portfolio in gold, but having some allocation to precious metals as insurance against currency debasement and financial system instability is just prudent risk management. The third thing you should be thinking about is the specific risks that BlackRock is apparently worried about. Because their actions reveal their concerns even if they're not explicitly stating them in public communications. The massive move out of U.S. assets suggests concerns about several potential scenarios. They might be worried about U.S. debt sustainability, which is a real issue given that we're now running deficits of $2 trillion even when the economy is supposedly strong. They might be concerned about political instability and policy unpredictability in America, which has gotten significantly worse over the past decade regardless of which party you support. They might see demographic challenges in the U.S. that are going to constrain economic growth and tax revenues while increasing spending obligations on Social Security and Medicare. All of these concerns point to a potentially rocky future for U.S. asset prices, especially when valuations are already quite elevated by historical standards. The U.S. stock market is trading at much higher price-to-earnings ratios than most international markets, which means you're paying more for each dollar of corporate earnings. If growth slows, or if there's any kind of multiple compression where investors decide they're not willing to pay such high valuations anymore, U.S.-owned stocks could underperform significantly, even if corporate earnings don't decline. Meanwhile, international markets that are trading at cheaper valuations have more room to run if economic conditions improve. Another critical factor that BlackRock is clearly considering is the changing nature of global supply chains and manufacturing. For decades, the model was that America designs products, China manufactures them, and everyone else provides raw materials or serves as consumer markets. That model is breaking down rapidly due to geopolitical tensions, pandemic-exposed vulnerabilities, and the desire of many countries to have more self-sufficient economies. We're seeing massive investments in reshoring and nearshoring of manufacturing, diversification of supply chains away from China, and the development of regional production hubs. This shift creates enormous investment opportunities in countries that are positioned to benefit from the restructuring of global manufacturing. Vietnam, Mexico, India, and Eastern European countries are all seeing significant inflows of manufacturing investment as companies look to reduce their China exposure. BlackRock's capital allocation reflects their belief that this trend is going to continue and accelerate, creating decades of growth in these alternative manufacturing hubs. If you're a retail investor, you can participate in this trend by investing in companies and funds that have exposure to these emerging manufacturing centers. I also want to talk about something that doesn't get enough attention in discussions about institutional capital flows, and that's the political economy of wealth preservation. When you're managing $10 trillion, you're not just thinking about financial returns. You're thinking about political risk, regulatory risk, tax policy, and the stability of property rights. BlackRock's move out of America could partly reflect concerns that the political environment is becoming more hostile to large concentrations of capital. We're seeing increasing calls from both the political left and right for higher taxes on corporations and wealthy individuals, more aggressive regulation of financial institutions, and even discussions about wealth taxes that were considered completely fringe ideas just a decade ago. From BlackRock's perspective, diversifying geographically isn't just about chasing returns. It's about reducing concentration risk in any single political jurisdiction. If you have all your assets in one country and that country decides to implement policies that are hostile to capital, you're stuck. But if your assets are distributed across dozens of countries with different political systems and different policy environments, you're much more resilient to any single government's decisions. This is the same principle that individuals should be applying to their own portfolios, even if they're not managing billions of dollars. Now, I want to address something that I know some of you are thinking. You're wondering if this is all just fear-mongering, if I'm exaggerating the significance of BlackRock's moves to get views and engagement. That's a fair question, and I want to be completely transparent with you. Could BlackRock's allocation shift be partly routine rebalancing that happens to involve large numbers because they manage so much money? Sure, that's possible. Could some of this simply be following client mandates for more international diversification? Absolutely. Investment management is complex, and there are always multiple factors driving portfolio decisions. But here's what I would say to that. Even if this particular dollar figure is somewhat overstated, or if the moves are more nuanced than a simple headline suggests, the directional trend is undeniable and has been building for years. Institutional investors across the board, not just BlackRock, have been reducing U.S. overweight positions and increasing exposure to international markets, alternative assets, and inflation hedges. This isn't one firm making an idiosyncratic bet. This is a broad-based shift in how sophisticated investors think about portfolio construction in the current environment. The specific number might be debatable, but the trend is absolutely real, and it's accelerating. What I am trying to do here is give you information and analysis that helps you think more critically about your own financial decisions. I'm not your financial advisor, and I can't tell you specifically what to do with your money, because I don't know your individual situation, your goals, your risk tolerance, or your time horizon. But what I can do is help you understand what's actually happening in the world of institutional finance, why it matters, and how you might think about applying these insights to your own circumstances. The bottom line is this: the investment landscape is changing rapidly, and the strategies that worked for the past 40 years may not work for the next 40 years. We're transitioning from a period of American economic dominance, dollar supremacy, low inflation, and declining interest rates to something fundamentally different. A multipolar world, currency competition, higher inflation, and more volatile interest rates. The institutions that manage trillions of dollars are adapting to this new reality by repositioning their portfolios. The question is whether you're going to adapt as well, or whether you're going to stick with conventional wisdom that is increasingly out of touch with current reality. I encourage you to do your own research, to question the standard advice you get from traditional financial sources, and to think critically about whether your portfolio is positioned for the future or anchored to the past. Look at what the smart money is actually doing, not what they're saying in press releases and quarterly letters. Follow the capital flows, understand the trends, and position yourself accordingly. The opportunity to build significant wealth over the next decade is absolutely there, but it's probably not going to come from doing what everyone else is doing. It's going to come from having the insight and courage to position differently before the crowd catches on. If you found this analysis valuable and you want more content that goes beyond surface level financial news and actually helps you understand what's really happening in markets and economics, make sure you're subscribed to this channel and hit that notification bell so you don't miss future videos. I'm committed to bringing you the kind of deep analysis and actionable insights that can actually make a difference in your financial life. Share this video with anyone you know who's serious about building and protecting wealth, because this information is too important to keep to yourself.